Hey, good afternoon, everyone. Glenn Setchfield here, VP of Marketing for DMI. And welcome to today's DMI University webinar, Build Fully Funded Plans with Less Capital. Today, we're looking at a smarter way to approach retirement income planning, one that can help advisors create stronger outcomes, use less client capital, preserve more AUM, and bring more clarity to the income conversation. And we're joined by a good friend, Andy Robertson, CSSCS co-founder and vice president, who works with accomplished retirement planning professionals across the country and brings really deep insight into Social Security planning. We also have Eric Lindewall, DMI vice president of annuity sales, who brings 35 years of industry experience and a practical case design mindset to every advisor conversation. Um, One thing I would add today, guys, really appreciate everyone joining. But to get the most out of this webinar, use the Q&A, and at the end, we'll do our best to answer all the questions. But Eric, you've seen this from the advisor side, the wholesaler side, and the case design side. So I think you're the perfect person to help frame why this really matters right now.
Sure, sure.
And what I want to do is just turn it over to you first before we go to Andy, if you don't mind.
Great. Thanks, Glenn. And good morning or afternoon to everyone. Thank you for taking the time out of your day to join us. This topic and this concept that we're going to discuss today is really interesting in a number of ways. As a wholesaler, I speak with advisors all over the country, and obviously, retirement income planning is really the most popular topic that we talk about on a daily basis. When you think about the clients that you have these conversations with, they're typically easing up towards that time in which they're going to retire. We spend most of our working life in accumulation mode, trying to gather assets and invest assets and try to make sure we have enough assets for retirement. And when we start to have the retirement income conversation, folks have an idea in their mind of what they think they're going to do with respect to when they're going to claim Social Security and how they're going to take retirement income. But quite frankly, they really have no idea whether their plan is sound and will actually work. And so there's this challenge we have where we look at someone's overall financial picture, and we try to figure out if we're going to be able to get to the finish line with their current structure. What Andy has done and what CSSCS has done is created an amazing tool to help people visualize what their retirement could look like and get a sense of how it needs to be structured to create peace of mind in that their retirement income will be sufficient and fully guaranteed for their whole lifetime. You know, nobody ever solves a problem, I believe, nobody ever solves a problem that they don't know exists. And what Andy's going to walk through today is going to be a way for you to create a relationship with a client where they identify particular opportunities for improvement in their retirement income plan and show them with really, in many cases, one key strategy change and one key allocation change, how they can dramatically improve their retirement income outcomes. So as Andy walks you through this process, keep that in mind that ultimately we're trying to get to a better outcome for each and every client you talk to. It's a revolutionary tool, and I think it'll help you have better conversations with your prospects and turn them into clients. So, Andy, thank you for joining us. I always enjoy these sessions. And Glenn, back to you.
You know what? I'm gonna just let Andy jump right into it. And Andy, again, thank you so much for being here, and look forward to the presentation, good sir.
Yeah. Well, I'm always excited here to talk to my good friends at DMI and talk a little bit about retirement income planning and really how you can make yourself a retirement income specialist at a time, in my opinion, where being a specialist may be more important than it's ever been. I don't have to tell everybody on this call that the world as we know it is changing. The landscape around retirement income planning, as well as a lot of other service industries, the model is going to change. AI is going to have a significant impact. How you go about bringing value to clients is going to be the difference between, in my opinion, remaining relevant and holding on to those clients versus being displaced. So I don't have to tell you there's a lot of opportunity with AI and other things to really make your practice better and improve the client experience. But the biggest thing, in my opinion, is how do you preserve your value, the human value, in the process. And ultimately, this is just one of the ways, in my opinion, you can really do that. And what we're really talking about today is making yourself a retirement income specialist. And the value of making yourself a retirement income specialist, as the folks at DMI have communicated to you, is the opportunity to really build better, more fortified plans for 50% less capital. And it all starts with what I would argue is the most dynamic tool in the retirement income planning toolbox, and that's Social Security. So I've been in this business, it'll be 37 years in June. And even today, the vast majority of the people I know, while they talk about Social Security with their clients, they really don't understand it in a way that's going to allow them to differentiate themselves from the competition. So, clients understand the concept of break even, and frankly, they don't need a financial advisor to tell them what the break even point is in a Social Security analysis. So we're going to go beyond break even today. We're going to really talk about how to leverage that tool that's in the toolbox and available to everybody in a way that they haven't thought of or could comprehend. And maybe the same is true for you. But in the end, what you're going to see is a real opportunity to ultimately differentiate yourself at a time when differentiation is going to become more critical than ever before. So when I talk about Social Security optimization, I'm talking about not break even, but how to leverage Social Security in a way as part of the overall plan that it helps you build a better, more fortified plan for your clients. So let's get going here. Keep myself on schedule today. Right now, you guys all know this if you've been in the business for any length of time, Americans are being told across the board that ultimately the transition from defined benefit to defined contribution is looking like it might be a failure, but not because defined contribution plans are a problem. No, because Americans are crummy savers, right? And as a culture, we're just not good at saving, which may be true. But the reality is virtually all of the academic work that's been published that says like this particular statistic says here, 77% of Americans working households are not on pace to meet their retirement savings targets, assume everybody is going to take Social Security benefits early. And what I'm here to tell you is that's true. If everybody takes benefits early, these numbers they prove out. But Social Security is the one last opportunity you have as a financial advisor in many instances to change the paradigm, to make sure that your clients end up on the right side of this equation, not the wrong side. And what I'm going to prove to you quantitatively is for many people, they don't have to do something different. They don't have to delay retirement if they're underfunded. They don't have to save more money. They don't have to reduce their income expectations in retirement. They don't have to become more aggressive. What they need to do is work with someone who can truly quantify the impact Social Security can have on their overall retirement plan. Now, when do people historically take benefits? No surprise. Statistically speaking, the vast majority of people take benefits early. But the thing I want you to think about is why do they take benefits early? When I talk to consumers, what do they tell me? By and large, they say, I'm going to take benefits early, even though I might get more if I wait. I'm going to take benefits early because I may not be here, right? Or maybe they'll say Social Security won't be here. But when push comes to shove, most of them will dig their heels in and tell me, well, I'm just concerned that I'm not going to make it until 70. I'm not sure that I'm going to be here. Okay. Interestingly, in our software that we've developed around Social Security optimization, we ask how long do you want this income plan to last? So one question is when are you going to take benefits? It's always early, by and large. Then we ask later, how long do you want the plan to last? What do you think they say then? They say 25, 30, 35 years routinely. They want the plan to last forever, for as long as they do. So what am I missing, right? Begs the question. So 2 minutes ago, you were trying to convince me you wouldn't be here at 70, but when I talked about retirement income planning separately from Social Security, you said, "Oh, I know I need my retirement plan to last 30 years." So the point I'm making is the one thing you can be pretty confident about is people do not see Social Security for what it is, right? They see it as something different than a retirement income plan, and they're focused on not making the wrong bet. So everybody views Social Security as a bet, and they don't want to make the wrong bet. So what would the wrong bet be? The wrong bet would be to not take benefits in their mind at 62. Wait all the way till 70 because they know they're going to get more. Maybe they don't know how much, but they know they're going to get more. And on their 364th day of their 65th, 69th year, right? 1 day short of attaining age 70, slip and fall off a 1,000-foot cliff. All they'll be thinking about is, oh crap, I should have taken Social Security at 62. That's what they live in fear of. That would be the wrong bet, right? I get that. But at the end of the day, what we have to do through education is help them understand what's the value of waiting beyond that. What are you gaining? So they all know what the wrong bet is, and they can tell you. They don't really understand what ultimately the opportunity cost is for making that bet, which is taking benefits early, thinking, they may not live long enough. They may not live beyond 70. In spite of the fact that they intuitively know they need to build the plan to last beyond 70. Now, first thing I'll share with you, if you're going to talk about Social Security, you really have to understand how these benefits are built, right? So if we have somebody who has a full retirement age of 67 and they opt to take benefits as early as possible, 62, there's a fractional reduction for every month they opt to take benefits prior to FRA. And that equates to these numbers on an annualized basis. So ultimately, if I take benefits as early as 62 with a PIA of 67, I'm going to see a 30% reduction in my primary insurance amount, right? And my benefit, right? So my benefit's going to be reduced by 30% over what it would have been had I waited to take benefits until full retirement age. So instead of getting $1,000, my simple example, they get 700. Now, conversely, if they wait, they don't take benefits prior to attaining full retirement age, and they wait, for every month they wait, they earn a delayed retirement credit. And those delayed retirement credits equate to 8% simple per year, a total of 24% for those with an FRA of 67. So the increase is 24% over what you would have gotten at 67. What nobody really seems to understand is what's the difference under current Social Security formulas between what I'm guaranteed to receive at 62 and what I'm guaranteed to receive at 70. And the answer is 77%. So to be clear, my goal again is to help them understand what are they missing, right? What's the opportunity cost? What are you potentially giving up from an economic value perspective by taking early? Well, you're guaranteed to receive at least 77% more at 70 than you would receive at 62. Cannot be less, but it could be more. Again, cannot be less, but it could be more. I'm going to touch on that here in a couple of minutes. Now, for those people who they're concerned about delaying. They don't want to make the wrong bet. A lot of them come up with what I'll call a hedging strategy before they get educated. And they say, well, you know what? I'm going to take benefits early. I'm going to take as early as possible, 62. I'm going to take that check. I'm going to save every check between 62 and 70. This way, if I'm still here at 70, I can use that extra cash that I've accumulated by taking checks early to match that 77% Andy just talked about. And if I slip off that cliff, I die knowing that I didn't leave any money on the table because I collected every check between 62 and 70. Well, I will tell you what I tell everybody. That sounds really good in theory, like a lot of things in financial planning, but here's the first challenge you're going to be up against. If you take benefits prior to age 62 and you continue to work and you have earned income, in 2026, if you have more than $24,480 in gross income, right? Not net after deductions, not net after, funding your 401k plan. If you have gross income in excess of 24,480, for every $2 you're over, you're going to forfeit a dollar in benefits. So what does that mean? Well, if you earn 72,480 in gross income in 2026, that puts you over the $24,480 threshold by 48,000. And we know for every $2 you're over, you forfeit a dollar in benefits. It means you're going to give up $24,000 in Social Security checks, right, in this year. And by the way, between 62 and 66, if this were you, you'd be giving up $96,000 in Social Security checks with an earnings level of this much. What's the point? Well, again, it sounds really good in theory to create this hedging strategy, but if you never get your hands on those checks, it's going to be very difficult for that plan to succeed. Now, let's assume the earnings test didn't exist for a second. The other thing we have to think about is how realistic is it to think that I could save every check like clockwork between 62 and 70 and have a big enough pile of cash to match that increase we were talking about earlier, right? So let's look at some numbers just to kind of put this to the test. Let's say we have a married couple and spouse one's PIA is 3,200, spouse two's PIA is 2,800. So together, if they wait until that Friday, they'd have $6,000. Of course, they're saying we don't want to wait. We're going to take benefits early. So they're going to take $4,200 a month and save it like clockwork for the next 96 months, right? And the idea is, we're assuming again the earnings test isn't there. The idea is they're going to have the intestinal fortitude to save every check. They're not going to use any of it, and they're going to build a big pile of cash. Okay, well, how big of a pile of cash is it? That'd be with no gains, $403,200, right? If you took benefits at 62, you save 4,200 a month, like clockwork for 96 months, just over $400,000. What would you get, however, if you waited? You didn't take it 62, you waited till 70, you get 77% more, right? So that's 7,440 at 70 versus the 4,200 you would have gotten at 62. So to be clear, what we're saying is the hedging strategy would be I'll take the 4,200 at 62, I'll save every check. Then at 70, I'll stop saving the check, I'll keep the 4,200, and I will draw 3,240 out of that secondary savings account so that the two together, the 3,240 for my savings account and the 4,200 I'm already getting, will match the 7,440 I would have gotten had I simply waited. Okay, great. The real question, though, is how much do you really have to accumulate in total capital between 62 and 70 to have a reasonable chance of matching that income you would have gotten from Social Security on an inflation adjusted basis for the duration of, let's say, a 30-year retirement? Well, to answer that question, we have to understand first and foremost, what are we really talking about? 3240 a month or 38,880 a year. So this is what we have to produce at age 70, 3880 to match the minimum increase we would have gotten had we simply waited. Well, how much capital do I need to deliver 3880 on an inflation adjusted basis for the balance of the 30-year period? So I'm assuming they retired 67, right? They don't take they took benefits at 62, they retired at 67. They don't actually start taking money from that secondary account until age 70, right? They save every check. So from 70 and beyond, if they have a 30-year retirement period and they retire at 67, they have 27 years left. How much do I need to fund 38,880 at age 70 and do it for another 27 years on an inflation adjusted basis? And to answer that question, I'm using what I would describe as a very credible process. You're all financial advisors, you're familiar with the 4% safe max that Bengen introduced to us back in the early 90s. A couple things about that 4% number in case you don't know. That's a gross number, right? So he made no assumption for fees in his work, and neither did the Trinity work when they did the Trinity work several years later. They called it the Trinity study at Trinity University. They came back and said they agree with Bengen, the numbers are accurate. In neither instance did they make any assumption for fees. So the first thing we have to do is we have to reduce this number to account for fees. The second thing is desired probability of success. So here's what I know. I believe that Social Security not only will be there, and I can explain why later, but as a result, to match it, we need a 99% probability of success, right? Not an 80% like they assumed in these studies. So as a result, we have to adjust the 4% to account first and foremost for the fees that we haven't accounted for and the fact that we want a 99% probability of success, not an 80. What does that mean? That means the net in your pocket sustainable initial safe withdrawal rate at 70 under those circumstances is 2.62%. Why do I need that number? I need to know if I'm going to deliver 38,880 and I'm going to withdraw from the capital I have a net in your pocket initial safe withdrawal rate of 2.62%. How much do I need at 70 to do it and have it last? Well, the answer is simple. $38,880 is 2.62% of what number? Here you go. $1,483,969. Just simple, straight up math, right? If you want to argue about the net in your pocket initial safe withdrawals, let me know. I use pure historical data in my simulator to arrive at the sustainable rate. I make no qualitative adjustments based upon forward-looking opinions about the markets. I'm using straight historical data. This is about as pure as you can get. I'm assuming a 25 basis point fee here. So 1.4, call it 1.5 million. Now, I mentioned earlier that if you save $4,200 a month like clockwork over 96 months, you'd have just over $400,000 by age 70. So where's the other million coming from? Obviously, you're going to invest all this money, right? And you're going to try and grow it in the capital markets. Well, what would you have to earn a compounding annual growth rate to accumulate this much capital in 8 years? Just shy of 34%. 34% above and beyond the $4,200 a month you save like clockwork. And if you were lucky enough to earn that kind of a return, that's all you'd be is lucky, you'd have enough money to have a chance of matching the 38,880 with a high degree of success, right? Now, the real question is, what compliance department on earth is going to let you position your client's assets in such an aggressive way that even if the market delivered 34% like clockwork over any 8 year period, you were fully invested and fully participated? I think we all know it's highly unlikely, right? And again, all you'd succeed in doing if you did achieve a 34% is match. Of course, the downside is not something that the client could deal with, and that's why there's no compliance department to let you do it. Now, I've already said a couple of times that the 77% increase is a minimum increase, cannot be less, but it could be more. Here's the other thing that's critical for people to understand. Once you reach that first year of entitlement, age 62, whether you're collecting Social Security benefits or not, again, I'll say it again, whether you're collecting or not, once you reach age 62, every year that a cost of living adjustment is declared between 62 and 70, even if you're not collecting, your primary insurance amount is increased on a compounded basis to account for that cost of living adjustment. So, what am I saying? The only way you would have just a 77% increase by the time you attain age 70 is if not a single COLA was declared between the time you attain 62 and the time you attain 70. How unlikely is that? Well, here are all the numbers since COLAs became automatic. There's only been 3 zeros in the history, and there was only one time it was in 2 consecutive years. So I'd say it's highly unlikely, especially given the environments we've seen here more recently, that you would find yourself in that position. And in fact, the average cost of living adjustment historically is 3.725. But what I do every year is I update the numbers and I go backwards. And I say, what if I attained age 70 on January 1st, 2026, which means I attained age 62 on January 1st, 2018? If you talked to me on January 1st, 2018 and said, how much more am I going to get? I would have said, as I've said here several times, you're going to get at least 77% more. Cannot be less, but it could be more. How much more I won't know until you attain age 70. Well, what was the actual increase when we applied these COLAs that were declared on a compounded basis? The actual increase was 139%. And I'm not cherry picking here. I'm just picking the last period of time. So I update this every year. But I've seen this as low as 100% since I've been doing this, which is about 16 years. And I've seen it now at 139%. The point is, the odds of matching a 34% increase, I think we can all agree, are obscene. No chance. What are the odds you're going to match 130 to deliver 34% to match a 77% increase? What are the odds you're going to earn enough to match a 139% increase? I didn't bother doing the math because I think we all know the answer. There's no chance. So the point here is, again, to highlight the economic value that's often overlooked by a break-even analysis and not recognizing that maybe the simplest solution to this so-called savings problem we have in this country is just leveraging Social Security differently. Here's why I say that. Quick case study. Let's say we have a married couple, both age 62. They have an annual income goal in retirement of 108,000. They want to retire at 67. The time horizon is 30 years, meaning they want the plan to last for 30 years, and they have a desired probability of success of 99%. And together they save 1.2 million in assets. What I'm going to do in this next phase, I'm going to talk about how much capital do you need for these objectives to be met if they take benefits at 67, and then I'm going to look what happens to the capital requirement if they take benefits at 70. This is a simple, straightforward example of how taking benefits at different times may be the simplest solution your clients can find to this savings issue. So we'll call scenario one, which is taking benefits at 67, the earlies. So if using those same primary insurance amounts we talked about earlier, if they take the 3,200 and the 2,800 or the 6,000 together, Social Security is going to provide 72,000. If they delay, which we're going to look at secondarily, we'll call that the laters. At 70, they're going to get, we know they're going to get 24% more than they would have gotten at 67 because of the DRCs, right? So they're going to get 89,280. Again, we're going to look next at, does it impact the amount of capital we need taking benefits at these different times? So in order to answer that, we first have to know how much income does the capital they've accumulated have to deliver to make this plan whole. So under the early scenario, Social Security is going to deliver 72,000. We need 36,000 from the assets to get to 108. And for the laters, Social Security is going to deliver all but 18,720. Is that going to change the calculus and determine make the 1.2 million more user friendly, right? So now we're going to look here at this, and we see 36,000 using the same exact credible, what I call credible approach to backing into the capital required. We're going to use the initial safe withdrawal rate, but now not only are they not only are they retiring at age 67, but they're taking benefits at 67 or 3 years earlier than they would have in the example we gave earlier. So the initial safe withdrawal rate for them at 67 is 2.4%. The initial safe withdrawal is lower because we're adding 3 more years into the plan, right? So 36,000 is 2.4% of what number? $1.5 million. Do they have 1.5 million? No. They have 1.2 million, so they end up on the wrong side of that 77% equation if they do nothing. Now, what do they historically do? Their options have always been, well, if this is you, you could delay, you could save more money, you could reduce your income expectations, you could be more aggressive with your investment posture, or you could just roll the dice. My experience has informed me that most people, they just roll the dice. They say, well, I'm retiring, I'm committed, I'm done. I'm going to hope the market doesn't perform over the next 30 years the way it has over the last 30 years. So I'm going to roll the dice. Okay, but what if they didn't have to roll the dice? What if they didn't have to delay? They didn't have to save more money? They didn't have to reduce their income needs? They didn't have to do any of that stuff. What if just taking benefits at a different time could solve this funding issue? Well, here's what we know. That 18,000, I think it was $796. If they retired 62, there's no question that they're going to retire at 62. We're not questioning that. We're questioning when they should take benefits. So the laters are going to retire at 67. I said 62, 67. But now they're going to not take benefits till 70. So between 67 and 70, we've got to do a little inflation adjustment to that 18,796 we saw earlier. So by the time they're 70 and Social Security benefits kick in, the amount of capital we need on an inflation adjusted basis, or the amount of income we need from the capital on an inflation adjusted basis, is 20,515. Divide that by that same age 70 initial safe withdrawal rate you saw earlier, 2.62. They need $783,000 to deliver the balance of the income need on an inflation adjusted basis for the rest of their life. So starting to shape up like maybe delaying is going to help. But if we delay, we're adding a dimension to this, and that is if I retired 67 but don't take benefits till 70, what do we do to fund their income need from 67 to 70? We call this period the bridge period, and we call the amount of capital they're going to need to utilize out of their retirement savings to carry them during the bridge period, the bridge capital. So in this instance, we're keeping it very simple. They're going to take 108,000, inflation adjusted by 3.1% for 3 years. So the total amount of bridge capital is 334,148. Add that to the 783 we just backed into and determined they need to deliver the balance of the income need, the 20,515, right at age 70 and beyond. Total capital requirement, $1.1 million. So think about what just happened, right? We took them from needing 1.5 million and being underfunded by 300,000 because they only have 1.2 to needing just over 1.1. And they didn't have to delay retirement, they didn't have to save more money, they didn't have to take on more risk, they didn't have to reduce their income expectations, they didn't have to roll the dice. They simply took benefits at a different time and reduced the amount of capital required to meet their stated plan objectives by 26%, right? So clearly, Social Security has tremendous economic value in this instance. Now, beyond taking them from underfunded to overfunded, we're adding, as an added benefit, some tax efficiencies they weren't even expecting, right? So by the time they're 70, whether they collect benefits at 67 or 70, that $108,000 initial income goal they have at 67 is going to swell to 118,358 as a result of the inflation adjustment we make each year, right? So 118,358 is what we need by 70. We're predicting that Social Security will provide for the early 78,906. For the laters, it's going to provide 24% more than that, or 97,843. The 36,000 the earlies needed at 67 is now 39,452 at 70 because of inflation. And we know the laters need 20,515 on an inflation adjusted basis. The taxable Social Security for the earlies is 35,669. So on 78,906 of total Social Security income, less than half of it is considered taxable. And for the laters on almost 98,000, only 27,621 of it's taxable, not even a third. Total taxable income for the earlies, when you take the 39,452 from the IRA to fund the gap, and the taxable Social Security is 75,121 on 118,000. This is shocking to a lot of people. But how about for the laters? $20,000 in a fully tax-infested IRA distribution to close the gap at 70, and 27,621 in taxable Social Security. Total taxable income 48,136. So to be clear, not only do we build them a more fortified plan, but we're providing 24% more guaranteed income from 70 and beyond, and 36% less taxable income before we apply any standard or bonus deductions. Now, here's the thing about taxes that people are unaware of. They all, in my experience, they all know there's these 50% and 85% kind of brackets they have in their mind. What they don't understand is these are a function of these thresholds that we see right here, right? So if I'm a married couple filing jointly and they have more than 32,000 and less than 44,000, then up to 50% is taxable. But what is taxable? Well, most people think it's either their total income or this number is applied, this threshold is applied to their total income or their Social Security income. Right? In either instance, if that's how it worked, clearly, would be at more than the number we just saw for the earlies, right? Because their Social Security alone was $75,000. And of course, if you're married, finally jointly, and have more than 44,000 of what? Up to 85% is taxed. And the of what is really the important thing to understand. These thresholds are not applied to your gross income. They're not applied to your Social Security income. They're applied to your provisional income. And this is where the magic happens. No other form of income that they've ever had before receiving Social Security is taxed like this. So they're completely unaware. But your provisional income is arrived at by using the provisional income formula, which simply takes all 100% of your modified adjusted gross income. This is just a fancy way of saying all your earned and unearned income, including tax-free dividend income, right? All of that is counted at 100%, but only half of your Social Security benefit is counted under provisional income. So clearly, a plan more heavily weighted in Social Security is going to tend to be more tax efficient. But it's that number that these thresholds are applied to, and it's not a flat tax. It's not a retroactive tax once you cross over. It's a progressive tax, so it's up to 50 or up to 85. So what does that mean? I'm going to show you real quick how we would show the taxation of the earlies. So there's three ways you can back into the taxation of Social Security. This is test three. The earlies, they had 78,906 at 70 in Social Security income, 39,452 from the IRA. We take half the Social Security, all of the IRA distribution. Now we have the total provisional income value. Now you subtract from that provisional income number, the 78,905, the $32,000 threshold, everything over that first threshold up to the 78,905, we're going to count at 50% in step one. Step two, to arrive at the taxable Social Security, we take that same provisional income number. Now we subtract the second threshold, 44,000, up to 78,905. That's 34,905. We take 35% of that number, and these two numbers together give us the total taxable Social Security. Now, to be clear, the reason why I'm only asking for 35% of the amount of money over the second threshold is because I already counted everything over the first threshold, which is only 32,000 at 50%, right? So we took everything over 32,000 up to the provisional income value, 78,905. That's 46,905. We already counted for that at 50%. So in step two, because I've already counted everything over 44 up to 78,905 in step one at 50%, I only have to pick up another 35 to get to 85% on everything over 44. I'm happy to answer any questions on this after. But basically, you have 35,669 in taxable Social Security on almost $79,000 of Social Security income. Now, how about for the laters? Significantly more guaranteed income from Social Security, significantly less fully tax invested income from the IRA. Provisional income's only 69,437, in spite of the fact that we have considerably more guaranteed income, 24% more. Simple math, take the first threshold, everything over the first threshold up to the provisional income number counted 50. Second threshold, add another 35 on everything over 44. Now that's how we get to the 27,621. So to go back to where we started, we're providing an income plan that's not only fully funded with the amount of capital they have, right? They're not underfunded by 300,000 like they were initially, but we're also delivering 24% more guaranteed income, 36% less taxable income, thanks to the tax efficiency afforded the plan that's more heavily weighted in Social Security. Now we turn around and apply standard and bonus deductions. Hold that number in your mind, 48,136. When you file in 2027, if you're over 65, if you were over 65 in 2026, when you file your 26 return in 2027, your standard and bonus deductions for a married couple filing jointly over the age of 65 is 47.5. Okay? So everybody's entitled to this, right? I don't have to itemize to get that. And if you do itemize, you can still get the bonus deduction. That's a conversation for later. But if I have taxable income before deductions of 48,136 and I get a standard and bonus deduction of 47.5, what am I talking about? I have about, what, 600 and some odd dollars of taxable income. Now I'm going to apply a marginal tax rate of 10%. I owe 50 plus dollars a month in federal income tax. So think about what happened. We're paying them by the time they're 20, the time they're 70, almost $10,000 a month in income, fully guaranteed in the earliest case. No, it will be. Pardon me. In the latest case, not fully guaranteed. 24% more of the income is guaranteed, and we owe nothing in federal income tax. So the income tax piece wasn't the feature; it was an added bonus. But it's not a bad added bonus, right? If I can deliver all that income to you, you don't have to pay anything in taxes. That's a home run. So again, what happened? We went from underfunded initially for the earlies by $300,000 to the laters being slightly overfunded. That's a 380, almost $383,000 swing in your client's favor. And how'd we do it? We didn't have to pick the right stocks, the right bonds, the right crypto, right? We didn't have to get lucky with market, timing, I guess. We simply leveraged Social Security at a different time, and the result for the client is profound. They go from a plan that has 67% of their income goal guaranteed, 67% automatically inflation adjusted without market exposure, 61% taxable, and a guaranteed survivor income of 38.4. By waiting till 70, here's the difference, right? And again, we took them from underfunded by $300,000 to slightly overfunded, and it's highly tax efficient. The real question, though, is how could we make this plan even better? By partnering with DMI, we can go out to the product providers that they work with and find the products that's going to deliver that same $20,515 on a contractually guaranteed basis and do it at a deeply discounted level, right? So ultimately, what this story comes down to, this idea that I'm going to build a better, more fortified plan for half the capital, it comes down to taking advantage of two leverage points that virtually everyone has the opportunity to take advantage of. Number one was Social Security, which we just demonstrated, right? Didn't require them to do anything capital wise, enough to save more money, right? Just leveraging that point a little differently. The second is bringing guaranteed lifetime income benefits into the equation. I went back to Eric and the team at Athene said, the team at DMI said, what do we have to invest in Athene, the Cent Pro 10, to guarantee the 20,515 with the indexed earnings rider, right, at age 70, and do it on a contractually guaranteed basis for the duration of two lives? And the answer was 287. Invest 287 today. Add that to the bridge capital because they're still going to retire at 67, but not take benefits till 70. And now we need 621. So to be clear, they needed $1,500,000 if they took benefits early, retired at 67 and took benefits early. They needed $1,100,000 if they retired at 67 and took benefits at 70. And if they retired at 67 and took benefits at 70, and instead of using an asset allocation approach to deliver the income and committing 783, they use an annuity, they need 621, 472. So we went from $1,500,000 to 621. We cut it by more than 50%. And what did we do for the client in the process? We built them a better, more fortified plan. They went from underfunded by $300,000 to overfunded by $578,000. That's an 800 and call it $82,000 swing in their favor. And what did it do for the plan? The amount of their income goal that's guaranteed went from 67 to 100%. The amount that's automatically inflation adjusted without market exposure is at least 67%. That's the portion attributable to Social Security. Plus, we have the ability to see the income grow within the annuity as well. Income goal considered taxable before deductions, 61 to 40. They're still income tax free, as we talked about. And the guaranteed survivor income went from 38.4 to 68.1. Again, all of this accomplished by simply leveraging all the tools in the toolbox and taking advantage of the opportunity it presents to drive down the amount of capital we have to commit. If you think about it from a tactical perspective, here's what the traditional plan looks like. Take all the money, throw it in an asset allocation model, right, and do a systematic withdrawal for the balance of the client's life. Sounds good. Here's the problem. 1.2 million is only 75% of the 1.5 million they need. There's nothing left for you to commit to discretionary needs, nothing left for legacy. Ultimately, you're going to depend on this one bucket to not only fund your monthly income needs, but any other cash flow needs you might have during your lifetime. Under our plan, the optimized plan, we took 52% of the capital, fully funded the annuity, fully funded the bridge capital. That left 578, 528. You could do whatever you want with 300,000 in a discretionary bucket, 278 in a legacy strategy. Ultimately, at the end of the day, under an asset allocation approach, I cannot tell you exactly how much capital it's going to be you're going to need to fully fund that plan. It's pure speculation based on historical returns. I cannot tell you exactly how much you're going to need until the death of the second spouse. Under the optimized plan, I can tell you exactly how much you need today, so you know exactly how much we have left that we can use unequivocally for better, more meaningful planning opportunities while you're alive. The only objection you get, of course, to annuities, aside from cost, allegedly, is liquidity, right? So when people say to me, well, I'm concerned about liquidity. Okay, so let me be clear. You want access, right? You want control, right? You want liquidity. Well, you have $578,528 you can burn through under our plan before you ever destabilize the fully funded, highly inflation adjusted, highly tax efficient plan under the optimized strategy. You have nothing to burn through before you destabilize an already unstable plan if you use the asset allocation approach. So, just to kind of close it out, my goal is to help you see that for many clients, whether or not they've saved enough money is not the issue. The real issue is whether or not they're working with the right people. For many people, whether or not they have enough money comes down to who they work with and whether or not the person they work with is a specialist who leverages all the tools in the toolbox. Through our partnership with Athene, we give you access to the education, the training, and the tools you need to bring this story to life and make yourself a retirement income specialist in your marketplace. We have the Retirement Asset Optimizer, which is the proprietary software I've built that we use successfully and advisors use across the country every day to build these types of plans and show quantitatively the impact for their clients. Here's a quick look at ultimately how it plays out. Here's the plan comparison page that runs down the numbers we just went through. It's a game changer and very compelling for your clients who, frankly, have no understanding of how to invest money for income. They understand growth and growth alone. They've never invested money for income. They're trying to apply a growth investor's logic to a critical income decision. And for many, that flawed approach is going to be fatal. We can change all that. Ultimately, in the software, we also get into for your benefit what happens over the next 20, 30, 40 years, whatever the time frame is. What does it look like to the remaining capital that we don't need for income? What's the future value? Some would think, well, I put 1.2 million in if I use the earlies approach. If the market goes on, I'm going to fully participate under your plan. I only have 600 and some odd thousand to put in the market. Well, guess what? We thought of that too. It's in the software. And the Monte Carlo simulation actually projects what your odds are of having 50 to 100% of what you started with, 1 to 2 times, 2 to 3 times, 3 to 5 times. And you can see right here the green being the current plan wins in this instance every time. Here's what it comes down to. Where does this fit? What we do, the software, it's a client engagement tool that allows you to have that conversation about why you're a specialist without having to do a cavity search first and have them turn over every financial document they have. Once they go through this plan that you've developed and you show them quantitatively how working with you delivers them a significantly better outcome, they're happy to give you all the information you need and help you build that plan by having all that information at your disposal. So I'll kind of wrap it up there. But again, I'm Andy Robertson, Vice President, co-founder of the Corporation for Social Security Claiming Strategies. And our goal in life is to make you a retirement income specialist in your market and own the market for retirement income planning. I'll kick it back to you guys. Thanks.
Very nice, Andy. Thank you so much. Yeah, and you know what, guys? This certification, because it's not just the software, right, Andy? I mean, it's also the certification that can help bring better credibility, structure, and confidence in the social security planning conversation. Um, Eric, what are your thoughts on the value of the CSSCS certification, the software, anything else regarding the webinar today as
Yeah,
well?
happy to. And Andy, thank you once again. It's always, I learn a little something new every time I see you walk through that presentation. Folks, this is a game changer, and the Retirement Asset Optimizer tool is truly a game changer. The example I'd give you is this. When you do your initial sort of analysis using the Optimizer tool, you typically get the oh no from the client, right? Where the numbers show, hey, based on your desired level of income and what age you want to retire and what your plan is with respect to Social Security claiming, for many people, that delivers the oh no moment where they realize they're underfunded. And then the software walks them through sort of making that one key planning change, delaying their Social Security a little bit. And that gets them to the oh good moment, right? So we go from underfunded to slightly overfunded. And then the software shows them, and if you make that key planning change and one key allocation change, the annuity, that gets them to the oh thank goodness moment, right? That difference in that example that Andy walked through, going from a $1.5 million need and underfunded to being overfunded by nearly $900,000. You got to remember this. Those folks are still retiring at the same age they wanted to retire. They got the same level of income that they desired, and they were able to do so in a fully guaranteed and more tax efficient manner. They didn't save more money. They didn't change their plans. They just created a more efficient plan. And that's what the Retirement Asset Optimizer helps you walk a client through and helps them see the light. Again, I said earlier, nobody solves a problem they don't know exists. This helps people see the problems and the plan that they might think they want to undertake in retirement. So, as usual, Andy, you nailed it. Folks, we're here to help. We will connect you with Andy. We'll help you go through the certification process, and we will partner with you in every way possible to help make you the preeminent retirement income planning specialist in your local market. So, Andy, thanks. Glenn, back to you.
Yeah, hey, and Eric is the person you really want to contact after today's session. He can walk you through how to get started. If you're thinking about, hey, is this a fit for me and and the way I want to help my clients, he can help you think through that a little bit. But we do also have a couple questions, Maureen, correct?
We do. Andy, there's commercials out there that talks about increasing your Social Security benefit amount, and that you can receive as much as, $188,000 more by increasing it. Would you say that is a direct relation to delaying taking Social Security and using and implementing a process like yours?
Well, I think what you're referring to, Maureen, is some of the marketing out there that's really marketing what I'll call software tools. And the idea is a lot of the software that's out there, um, I hate to be so brash, but I call it "tell me when you're going to die" software, right? So basically, the way it works is it looks at Social Security in a vacuum. Tell me how old you are now. Tell me when you think you're going to die. If you can't decide when you're going to die, we'll use a mortality table to determine that for you. And then based upon those 2 points in time, we'll show you how much capital you would get if you took benefits at this time versus that time. And it's just a spreadsheet type analysis in the back end that you don't see. And it spits out, if you take it this time and your spouse takes it that time, you get, $120,000 more in lifetime income if you do it this way than if you do it that way. And, that's great. Don't get me wrong. I'm not saying there's anything wrong with that, but that's a far cry from understanding what Social Security can really bring from a value perspective. What we're showing them is in addition to getting additional income or more income, what if you could deliver that income tax free, right? What if you could reduce the amount of capital you need? That approach that you're talking about gives no consideration to whether or not the plan would even be funded properly. It just looks at Social Security in a vacuum. We're opening up the entire piece, the entire platform, and looking at everything. One thing that's worth pointing out, break even is really something I think everybody can kind of grasp. That's an analysis they want to do on their own. What they don't consider is the tax efficiency, right? So what did you just see in that window we were there? You're talking about over a 30-year period, you're talking about roughly $750,000 less taxable income. So even if they're in an effective tax rate of 20%, that's $150,000 less tax liability during your lifetime. And the numbers get even better than that, as I've shared with you guys. But that should be part of your analysis, don't you think? But if you're not working with somebody who even undertakes an analysis like that, you don't know. So you just look at break even and you walk away making a decision based upon break even, or you make a decision based upon lifetime income, and you don't look at this. I actually had a guy give a presentation at a firm that I presented at, and he said, "This is how I figure out Social Security." He did exactly what you're talking about. And then later I went up to him and I said, "I did some quick math. Do you know that if you took it at this time, they would have had $600,000 less taxable income?" The way you went about deciding when to take Social Security didn't account for that. And, he said, of course, yeah, 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 because he didn't really care because he doesn't want to deal with Social Security because it's too much work. But if you really want to be a specialist and beat the competition, especially in this environment where the world is changing very fast, you want to embrace that complexity and make yourself more valuable. So you asked me a loaded question, Maureen. Sorry.
No problem, Andy. Thank you. So Andy, I loved the demonstration you had at the end where you got to see the printout that you can get from your software, the retirement asset optimization tool. How does one get access to that?
Yeah, so you have to be a member. So you have to join CSSCS and go through our course. So it's 524.99 to go through the course. And then there's $50 a month fee that you begin paying in month two. That covers your annual renewal for your membership because you have to be a member to access the software, and it covers the software. But you'll also get beyond that, as a member of CSSCS, you get ongoing training, ongoing support from me and our team. So we'll help you with case design. I mean, Eric can speak to it, I'm sure, as well. We've had a number of his advisors that have brought cases to me that we've worked through and worked up on this that I think they ended up closing a number of those cases, and it brought real
Right.
value. So, but that's the additional part that you don't see is you don't just get access to the software and the knowledge, you get access to our team, including me, and the work that I do. And I spend most of my time talking to financial advisors about retirement income plans every day. So I'm going to help you through that kind of learning curve so you're not trying to figure it all out on your own because I know we're all too busy to learn something new without the assistance of someone else. So that's my goal is to turn everybody who joins on with us to turn everybody into a retirement income specialist with Social Security is really one of those cornerstone pieces.
Yeah, and then is there an advantage to going through DMI?
Well, there is an advantage to going through DMI aside from cost because you guys kind of co-write some of the cost, but also you get the team. So your team, I mean, I probably get shot for saying this, but your team is the one team I can say definitively has embraced this completely in the marketplace. They understand it. Eric can talk about it. I mean, I take notes when Eric talks. It's funny because he says every time I hear Andy, I learn something new, but he does a really nice job. He understands it really well. So Eric can help you not only with the case design and the positioning, but also more importantly, the area that I don't really specialize in is the products. And the annuity products are a critical piece of delivering on that value proposition of 50% less capital. And you really need to work with somebody like the guys at DMI who understand how these things all come together and why the product is so critical. And if you're not working with the right person, of course, you can get beat at your own game. So, yeah, nobody's better equipped than the DMI team to bring this whole package to you and support it from a marketing perspective, an ongoing support perspective. And I don't know much about the marketing that you guys do. I just know that it works really well because everybody is happy with it. But I know you guys will talk about that too.
Excellent. Thank you. And I have one more question, and it is, what do you say to people that say the Social Security Trust Fund is going to be going bankrupt or at least reduced soon?
Yeah. Yeah, great question. So I say a couple of things. The first thing I say to people is there's never been a credible source that says Social Security is going to be insolvent. If you look up the definition of insolvent, it says can't pay their bills. Social Security doesn't become technically insolvent until 2070 something if we do nothing. So the first thing I say is most of the people you'll meet, they'll bring that up as an emotional objection or concern. But if you ask them a simple question, how long is this conversation going to last, this retirement income planning conversation, if we assume Social Security is not going to be there? Because my guess is if we assume Social Security is not going to be there, we're not really building a retirement income plan, right? We're building a second, phase of life plan because you're going to have to keep working, right? Number one. Number two, um, think about it. I just say think about it logically, right? Just use your common sense for a minute when you're thinking about Social Security. Social Security is the primary income source for 76 million boomers alone. Never mind everybody else who collects it. The biggest fear people have is they're going to wake up tomorrow. Congress is, in the middle of the night, pull the rug out from under Social Security. They really are concerned that that could happen because every election cycle, our friends in D.C. turn this into a disaster. Last year at this time, we're talking about is stealing people's benefits. I mean, it's crazy the stuff that goes on. It scares the hell out of people. At the end of the day, your biggest fear is that you're going to wake up tomorrow and somebody's pulled the rug out from Social Security. Whoever it is, they did it, and you're out of money, right? Well, if we took the primary purchasing power, about 50% of the purchasing power from 76 million boomers out of the market tomorrow, what do you think might happen to our economy?
Right.
It's catastrophic, right? So Social Security, in my opinion, is the epitome of too big to fail. We learned in 2008 that certain financial institutions that weren't, by the way, backed by the full taxing power and faith of the U.S. government were too big to fail, and they were bailed out by who? The taxpayer, right? Well, Social Security is the epitome of too big to fail. There's a number of fixes. Um, the simple fix would be to raise the cap. Everybody knows it. Nothing's being done about it because they get too much leverage in an election cycle to do anything about it, and it's not as critical as it's been made out to be. But just think about it that way. Primary income source of 76 million boomers. If what you fear is going to happen happens, the whole economy is going to collapse. So it can't happen. And as far as them doing nothing, the only other thing is, you'll hear, well, if they do nothing by 2034, you're going to get, a reduction. And I say to people, well, think about it this way. Is that really, because what people say is that's why I want to take early. Well, think about it this way. If you knew for a fact you were going to get a pay cut in 2034, and you're only going to get to keep 75% of what you're getting, would you want to keep 75% of a 77% larger number or 75% of a 30% smaller number?
Right.
Right? To me, that's not a reason to delay. And I don't think everybody should wait. The software is built to focus on how much capital is required. What you'll find is it's different for everybody. I did two cases yesterday with a new advisor I started working with, and neither instance was 70 even close to the right solution for those clients. The right solution being the optimal solution being defined as the plan that required the least amount of capital. So I simply go to that extreme because I know from practical experience that most people can tell me why they should take it 62. They don't need me to tell them. They have no understanding of the opportunity cost. We're showing them the other end of the spectrum that they're missing out. So they understand they don't know what they don't know, and they really need to talk to somebody who works with us to figure that out.
Well, guys, this is why we partner with Andy. Andy, thank you so much. Really appreciate it. And please, I've had Eric's contact information up here for a little bit. use that, the QR code. If you scan that, it'll come up right on your phone. Give him a call. He's always happy to help. Um, I think that's it for the day, guys.
Hey,
Well,
Glenn,
everybody. And thanks for, and one more thing from Andy. You
I
good?
just want you to know, I don't know if they could see it because I think my presentation was still up. I just took it down, but maybe they could see it. But I can see it now, so maybe everybody can see it now. Eric's contact, that is.
Yep. Yeah.
Okay. Thanks again, guys. Always a pleasure.
Thanks, Andy.
Thank you. Y'all have a great
Cheers.
day. Happy
Bye.
Wednesday,
Take care,
everybody.
everyone.
You
Ciao.
too.